Hello, everyone, and welcome back to the deep dive. It is great to have you with us today.
Hey there. Glad to be back.
You're on the Smart Capital School of Financial Literacy channel, and today we're tackling a subject that, well, it honestly feels a bit like a ghost story.
Oh, I like that analogy
Yeah,
because it really is invisible, isn't it?
right. You can't quite see it happening right in front of your eyes, but you definitely feel the chill when you look at your grocery bill or your bank statement at the end of the month.
Yeah, it's invisible until suddenly it very much isn't. We're talking about the silent erosion of wealth.
Exactly. We are talking about the US dollar and specifically a number that frankly shocked me when I was digging through our research stack for this session.
11%.
The 11%. The dollar has fallen roughly 11% over the past year. It's hit a 4-year low. And look, we hear about inflation constantly, but this feels different to me.
Yeah, because it is different.
Right, this isn't just prices going up at the store. This is the measuring stick itself actually shrinking.
That is a crucial distinction to make right off the bat. Most people confuse inflation with currency debasement. I mean, they're cousins, sure, but they definitely aren't twins.
Right.
To really visualize what that 11% drop looks like, you have to look outside our borders. You've got to look at the exchange rate against the euro.
Okay, let's break that down.
So if you rewind just 1 year, the dollar and the euro were basically staring each other right in the eye, parity. $1 got you about 98 cents worth of euros.
Which, by the way, was fantastic for my vacation plans last summer. I mean, everything in Europe felt like it was on sale.
Oh, it's a traveler's paradise, absolutely. But today, that same dollar only buys you about 85 cents worth of euros.
Wow.
Yeah, that is a massive shift in purchasing power in a very, very short window. The dollar has been on this slide since January 2025, and it basically changes the math on everything.
Okay, but I have to play devil's advocate here immediately because the immediate reaction for a lot of listeners, and honestly for me too, when I first read this, is, well, so what?
The so what factor, yeah.
Right. I live in Ohio or Texas or New York. I earn dollars, I spend dollars. Unless I'm importing French cheese or, flying to Rome every single weekend, does this exchange rate actually hurt my portfolio?
See, that is the dangerous assumption. That's what we call the home bias trap.
Interesting.
The answer is yes, it absolutely impacts you, even if you never leave your hometown. First off, it hurts your purchasing power directly because imports like fuel, electronics, car parts,
Yeah.
they all get more expensive.
Because it costs more dollars to buy them from overseas.
Exactly.
Yeah.
But more importantly for this conversation, it flips the investment game completely on its head.
How so? Like mechanically, what happens?
Because the assets that worked so well for the last decade, back when the dollar was super strong, those are the exact assets that drag you down when the dollar is weak.
Ah, I see.
So this deep dive isn't about, panic selling or buying a doomsday bunker. It's about recognizing that the tide has turned.
So the mission today is basically to build a weak dollar playbook. We aren't trying to escape the dollar entirely, but we want to construct a portfolio that actually benefits when the dollar falls.
Exactly. We want to turn that 11% drop from a penalty into a tailwind.
I love that.
We're going to cover 6 specific areas today, and by the end, we'll actually break down a specific percentage allocation, basically a perfect portfolio to hedge against this debasement.
Okay, before we get to the solution, though, I need to understand the problem a bit better. Why is this happening right now? Is this just a normal market cycle we're going through, or is something structural fundamentally breaking?
It's definitely deeper than a normal cycle. You have to look at what's called the triple deficit problem.
Okay, triple deficit?
Yeah. We have fiscal concerns, specifically a massive national deficit. We have a trade deficit, and we have capital flow shifting.
Can you unpack capital flows for a second? That sounds a bit like Wall Street jargon.
Sure. Think of global money like water. It always seeks the highest level, or in financial terms, the highest yield combined with the most safety.
Makes sense.
For a long time, the U.S. was basically the only game in town. But now, with the Federal Reserve leaning toward easier policy, meaning lower interest rates, and inflation expectations rising, that capital is starting to look for a new home.
It's the fiscal dominance theory, right? The idea that the government has so much debt, they basically have to let inflation run hot just to bring it off.
That is the absolute elephant in the room. If investors believe the government is going to print money to pay its debts, they devalue the currency in their minds before the printing press even turns on.
Okay, so the water is flowing out of the dollar. We need to swim where the current is going. Let's look at the first strategy in our stack. It seems pretty obvious on the surface, international equities.
It is the most direct play. The math here is really simple. When the dollar falls, foreign currencies generally strengthen. So if you own a stock in the European company, you own an asset priced in euros.
Walk me through the mechanics of the return here. How does that actually look in my account?
Okay, say you buy a German manufacturing stock. That stock might go up 5% in the German market because the company did well.
Okay, solid year.
Right, that's your first return.
Mhm.
But if the euro also strengthens 10% against the dollar in that same year, when you translate that investment back into dollars for your portfolio, you actually made 15%.
So you get a built-in currency kicker.
You get a double whammy, the market return plus the currency boost.
But here's my hesitation with that. And I think a lot of investors feel this too. Europe isn't exactly a massive growth engine right now. Their economies are slower than the US. And emerging markets can be, well, volatile disasters sometimes. Are we just buying bad companies just to get a good currency trade?
That is the risk. You don't want to buy a sinking ship just because the tide is rising. However, the research shows that in weak dollar environments, the currency swing often outweighs that growth differential. Plus, you aren't just buying Europe broadly. You really should be looking at commodity exporting countries.
Like who? What countries specifically?
Brazil, Australia, Canada.
These economies are essentially double hedged.
Double hedged how?
Well, their currencies usually rise against the dollar naturally, and their economies are based on selling stuff commodities that get more expensive when the dollar falls.
Okay, so if I'm looking at my brokerage account right now, I shouldn't just be 100% in the S&P 500.
Diversification is the only free lunch out there. The sources highlight tickers like VXUS for total international exposure.
VXUS, got it.
But if you want to be a bit more surgical, you look at VEA for developed markets like Australia and Europe, or VWO for emerging markets like Brazil. You absolutely need that exposure to capture the currency upside.
Okay, so step one is getting some money outside the US borders. But this actually brings us to the second point, which I found fascinating because it feels totally counterintuitive, the US stuff.
Usually, the doom and gloom crowd tells you to sell all your US stocks if the dollar is dying. But our sources say, not so fast.
That's the twist. You don't have to abandon the US entirely to hedge against the dollar. You just have to be selective. This is the strategy of US multinationals.
So these are the big boys: Apple, Coke, Microsoft.
Exactly.
Huh.
Think about a company like Coca-Cola or Caterpillar. They are headquartered in the US, their stock is listed in New York, but they earn a massive chunk of their revenue overseas.
So it's the exact reverse of the import problem we talked about earlier.
Correct. If Coca-Cola sells €1 billion worth of soda in France, and the euro strengthens, when they convert those euros back to dollars for their quarterly earnings report, the revenue number magically gets bigger.
They didn't even sell more soda, but they made more dollars.
It's an accounting tailwind. And here is where it gets really nuanced. This helps their margins too.
How does it help margins?
Many of these companies have costs in dollars, like their headquarters, their R&D, but revenue in foreign currency. When the revenue currency gets stronger and the cost currency gets weaker, those profit margins expand.
So the whole narrative that a weak dollar is bad for US stocks is basically false.
It's false for global US stocks. It's very true for small domestic companies that import parts from China and sell only in Ohio. They get absolutely crushed.
Right.
But the S&P 500 as a whole is roughly 40% international revenue. So just buying the S&P 500 like through VOO or VTI is actually a partial currency hedge in itself.
Honestly, that makes me feel a lot better about holding my standard index funds.
You don't need to dump your core portfolio. Just understand why it works. You're betting on global commerce, not just the domestic US economy.
Right. So we've covered equities. Stocks are great, but they are paper assets. If the system really starts to shake, or if inflation runs super hot, stocks can still struggle. We need to talk about the hard stuff, the insurance. Let's talk about gold.
The barbarous relic.
Right.
It is the classic crisis insurance.
Why does gold love a weak dollar so much? Is it just a psychological thing where people panic and buy shiny rocks?
It's partly psychological, sure, but mostly it's mathematical. It's the denominator effect.
Denominator effect.
Yeah. Gold is priced in dollars globally. If the dollar, which is the denominator in that equation, drops in value, it naturally takes more of those weaker dollars to buy the exact same ounce of gold.
So gold isn't necessarily becoming more valuable. The dollar is just becoming less valuable.
Precisely. Gold is the constant. The dollar is the variable. But there's a massive geopolitical layer here too right now. Central banks, particularly the People's Bank of China, have been buying gold at a record pace.
Why are they doing that? Just to mess with the dollar?
They are actively trying to de-dollarize. They
Mm,
see the exact same jet issues we discussed earlier, and they want to hold an asset that no government can just print out of thin air.
makes sense.
When the biggest whales in the ocean are buying gold to get away from the dollar, that creates a really strong floor under the price.
Now, practically speaking, I always laugh at the zombie apocalypse scenario with gold.
Oh, yeah, it is a funny image.
The idea that if the power grid goes down, I'm gonna like shave off a sliver of a physical gold bar to buy a loaf of bread from my neighbor.
It's not practical at all. Hey, keep the change. It's just gold dust.
Exactly.
If you were actually prepping for total societal collapse, you want beans and bullets, not bullion. But for a financial crisis, where the banks are open but the money is just worth less, gold is the standard.
So, for the portfolio we're building today, are we burying chests of coins in the backyard?
I mean, you can if you like digging holes,
Yeah.
but the source material suggests ETFs like GLDM or IAU are much easier.
So, paper gold.
Yeah, they track the price without the storage fees or the risk of someone breaking in and stealing it. It's the liquid way to own the hedge.
Okay, we are going to pivot to the digital version of this in a second, but first we want to take a quick moment to check in with you, the listener.
We really do.
Thank you for joining us. Let us know in the comments how you like this format of video analysis and what topics you'd like us to cover in future videos.
We genuinely read the feedback. It helps us decide whether to cover more macro topics like this or dive into specific stocks.
Absolutely. Okay, let's address the elephant in the room. The asset that everyone claims is gold 2.0, Bitcoin.
You really can't talk about currency debasement in 2026 without talking about Bitcoin. But we need to be very careful here.
I'm going to push back on this one right away because back in 2022, when inflation hit 9% and the Fed started aggressively hiking rates, Bitcoin didn't hedge anything. It crashed. It lost like 70% of its value. So why should we trust it now as a hedge?
That is the most important question to ask. And the distinction lies in why the dollar is weak. In 2022, we had a liquidity crisis. Money became extremely expensive, so people sold everything, stocks, bonds, crypto, just to get cash.
So Bitcoin traded like a super risky tech stock.
Exactly. It traded like a tech stock on steroids. It was a purely risk-on asset. But the thesis for Bitcoin right now is that it is a debasement hedge.
Explain the difference.
It's the ultimate bet on scarcity. There will only ever be 21 million Bitcoin, period. The US government can print trillions of dollars, but they cannot code more Bitcoin.
Right. The supply is totally fixed.
As confidence in the dollar's long-term value erodes, Bitcoin transitions in the market's mind from a tech stock to digital gold.
So if gold is defense, Bitcoin is offense.
That's the perfect way to frame it. Gold preserves the wealth you already have. It moves slowly. Bitcoin is a speculative bet that the current monetary system is breaking, and this is the lifeboat out. It moves violently.
It's a high volatility hedge.
Yes, you definitely don't put your mortgage money in it. But in a portfolio designed to fight a falling dollar, it has a role. Because if the dollar truly loses its dominance, the upside in Bitcoin is mathematically uncapped.
Okay, moving on to the real stuff. We've done stocks, we've done the metals, we've done the coins. Now let's talk about commodities.
This is the literal fuel of the economy: oil, gas, copper, agriculture.
Is this just the same denominator effect as gold?
Mostly, yes. Oil is priced in dollars globally. When the dollar drops, oil instantly becomes cheaper for Europe, China, and Japan to buy.
Oh, so they buy more of it.
Exactly. Demand goes up, so the price goes up.
But isn't this risky? Like, if the global economy slows down, nobody needs oil, regardless of what the dollar is doing.
That is the danger. Commodities are highly cyclical. If we go into a deep recession, commodities will crash, even if the dollar is incredibly weak.
So when do they shine?
In a stagflation environment where economic growth is slow, but inflation is hard, high commodities are often the best performing asset class across the board.
The sources mention tickers like DBC for broad exposure or XLE for energy specifically. To me, it feels like an inflation tax hedge. Like, if gas costs more at the pump, at least my gas stocks are up to cover the difference.
Exactly. You are literally hedging your living expenses.
And finally, the asset class that I feel like we always underrate in these macro discussions because it's hard to just buy and sell on an app quickly: real estate.
This is a critical piece. In the outline for our perfect portfolio coming up, this takes up a significant chunk.
Why, though? If interest rates are high, doesn't that inherently hurt real estate values?
It hurts transaction volume, sure, because people don't want to move. But in a weak dollar and high inflation environment, real estate is a triple threat.
Break that down for me.
First, the replacement cost of the building goes up. Lumber, labor, concrete, it all costs more to build a new house. So existing buildings automatically become worth more.
Okay, so the base asset value rises.
Second, rents. Rents act like a slow-moving inflation adjustment. They tend to rise over time as the dollar weakens.
Right, landlords pass the cost on.
But the third piece is the real magic trick, the debt.
The 30-year fixed rate mortgage.
Yes, if you own a rental property with a 30-year fixed mortgage and inflation runs at 5 or 10%, you are paying back the bank with cheaper and cheaper dollars every single month.
That's incredible.
The inflation is actually paying off your debt for you in real terms.
That's basically a massive wealth transfer. Borrowers win in inflation, lenders lose.
Correct. But you have to be careful with how you own it. The source strongly suggests tangible rental properties, specifically residential real estate.
Why not commercial? Like, why not buy into an office building fund?
Commercial is really tricky right now. Long-term commercial leases mean you can't raise rents quickly to match sudden inflation. Plus, the vacancy risk with remote work is just too high.
That makes sense.
Residential reprices every single year when the lease is up. It's a much faster hedge.
And what about for those listening who don't want to go out and fix toilets at 2 a.m.?
REITs, things like VNQ or infrastructure ETFs like IGF. But be warned, REITs can be sensitive to interest rates in the short term. They can act a bit like bonds sometimes. Direct ownership is the purest hedge, but REITs are definitely the convenient one.
Okay, we have covered the entire landscape. We have our 6 players: international stocks, U.S. multinationals, gold, Bitcoin, commodities, and real estate. But obviously, a list isn't a strategy. We need a plan.
We need the actual allocation.
Right. The source gave us a percentage breakdown for a perfect portfolio designed specifically for this weak dollar environment. But before we slice up the pie, what are we throwing in the trash? What loses here?
Cash. Cash is the guaranteed loser here.
Wow, okay.
Think about it. If the dollar is down 11%, holding cash is voluntarily accepting a guaranteed 11% loss in your purchasing power.
And what about long-term bonds?
Extremely dangerous. If inflation rises, bond yields have to rise to keep up, which means the underlying bond prices fall. So avoid long-duration treasuries.
Okay, let's build the portfolio then. How does the expert actually allocate the percentages?
Okay, visualize the pie chart. The foundation, the biggest slice by far, is still U.S. multinationals. We are looking at 40 to 50% of the total portfolio.
That actually surprises me. I thought the whole point was that we were bearish on the dollar.
We are bearish on the dollar, but we are bullish on global commerce. You can't bet against American innovation. Funds like VTI or VGT give you that global growth engine. You ultimately need growth to outpace inflation.
Okay, so 50% stays in the U.S. What's next?
International stocks, 10 to 20%. This is your direct currency play. You want the direct exposure to the euro, the real, the Aussie dollar.
Got it.
Then real estate, 10 to 15%. This provides the steady income and that inflation debt hedge we just talked about.
That leaves roughly 20% left for the insurance side of things.
Right. And this is where you get aggressive with the hedges. Gold gets 5 to 10%. Bitcoin gets 5 to 10%. And commodities get 5 to 10%.
That is a wildly different portfolio than the standard 60-40 stock and bond split everyone is used to.
It is. Because the standard 60-40 portfolio assumes low inflation and a perfectly stable dollar.
And we are not in that world right now.
Exactly. This portfolio assumes the opposite. It's heavy on hard assets, almost 30% of the total, if you combine the real estate, gold, and commodities.
It feels balanced, though. Like, you aren't betting the entire farm on the apocalypse, but you have very significant protection if the dollar just keeps sliding.
It's a pragmatic portfolio. It's designed for the macro reality we're actually seeing right now. High deficits, easy Fed policy, and sticky inflation.
I want to leave the listeners with a final thought that really stuck with me from the research. We are so conditioned to think that cash is safe and things like stocks or Bitcoin are risky.
That's the traditional wisdom, right? Cash is king.
But if the dollar continues to lose 11% a year, holding cash isn't safety at all. It's a slow bleed.
It really makes you wonder, in this specific environment, is holding cash actually the riskiest investment of all? You are basically accepting a guaranteed loss just to avoid short-term volatility.
That is a really heavy thought to end on. Don't let perceived safety be your downfall. That wraps up our deep dive on the weak dollar playbook. We hope this gives you a clearer map for navigating these massive currency shifts.
It's been a genuine pleasure unpacking this with you.
Thank you for watching this video to the end. Subscribe to the channel, like it, and see you in the next retelling. Bye.
Goodbye, everyone.